With silver supply actually being sucked out of above ground stocks right now into this growing supply deficit, it actually raises the question, which we raised last time. What is that price? And while no one exactly knows, every well-connected liquidity provider assesses it has to be a three-figure price. And once the short squeeze and margin calls hit, it will happen faster than most people realize. This is why every single bullion bank, without exception, is long both gold and silver for their own books. So really, kind of to sum that up, at the margin, this completely unfactored, fresh, BRICS-driven SGE silver demand is going to make it impossible for the fast dwindling above ground supply. That there's not enough supply for the so-called LBMA silver professional trade that they call themselves to suppress a globally driven spot silver price breakout into all-time highs.
The global silver market is experiencing a supply deficit as above-ground stocks are rapidly depleted. This tightening supply, driven by increasing demand, will push silver prices to unprecedented levels, potentially into the triple digits. Analysts suggest the price breakout could happen more quickly than anticipated once short squeezes and margin calls occur. Bullion banks are reportedly positioning themselves long on gold and silver, indicating their expectation of a significant price surge. The diminishing supply makes it increasingly difficult for traditional markets like the LBMA to suppress silver prices, suggesting a potential breakout to new all-time highs. AndrewMaguire, also a prominent advocate for physical precious metals ownership, explains that the Federal Reserve's recent attempts to suppress gold prices through synthetic selling and short positions are failing, as global central banks and sovereign entities continue to buy physical gold. The Fed has reduced its gold loans with the Bank for International Settlements, but still faces significant exposure, with 75 tons of short positions likely to be covered by year-end. Despite efforts to trigger momentum-driven sell-offs, these strategies have not succeeded in causing technical damage to gold prices. Speaker AndrewMaguire highlights that initiatives like China's Shanghai Gold Exchange and BRICS-related policies are increasing demand for physical gold and silver, attracting large quantities of metal from Western markets. These developments point to global central banks' ongoing revaluation of gold, suggesting a strong year-end rally for gold and silver as the Fed loses control over pricing power. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
It was constructive because the Fed-induced synthetic gold and silver bid-pulling efforts once again ended up hitting the identified rising central bank sovereign and institutional bids, forcing discipline on the insiders exposed to delivering these physical delivery obligations. And we've seen that consistently as gold has risen and pulled back. And just a quick note while we're talking about the Bank of International Settlements. Following the Fed topping up the Bank of International Settlements gold loans to 157 tons in August, and this was around about 2,400 when they started adding these. They were short covering, but it had still reached an excess of 157 tons. So then they were forced to short cover these loans sequentially at around up to $300 higher, further evidencing the Fed is on the back foot. Now, we've just confirmed, once again, the latest BIS November gold swaps report shows the Fed had repaid another 12 tons of gold, cutting these loans to 76 tons. Look, the Fed is the only global central bank that is naked short gold, and having lost pricing power against the increasingly liquid physically settled prices, they no longer can control, that is, liquidity providers assess they'll have to square up the remaining increasingly underwater 75 tons of bets against gold by the end of the year. In other words, these deliberately constructed Fed selling efforts rely on the useful for momentum traders who control 75% of all the open interest, which we call casino chips because they're backed by nothing, and it relies on them taking the bait. But once again, despite throwing the kitchen sink here and sucking them in short, and usually they get about $100 up and down before they realize they're wrong-footed, And despite these efforts, they failed to generate enough leverage momentum-driven sell ignition to inflict any technical damage at all. Now, what they usually try and do is try and find people who've gone long, and certainly there'd have been longs here, and if they could have created enough sell ignition to trap them, we would have indeed breached the 2,500 level. Well, that's assuming there was no central buyers there, but we know there were, and they were front run, as pointed out last time. Now, all of this suggests both gold and silver are coiling for a strong end-of-year rally. Now, each successive failed Fed attempt to cap gold exposes the Fed's weakening gold hand being read by the global South central banks and sovereigns who take full advantage of the Fed's efforts to sell freshly printed fiat gold, not real gold, fiat gold, in their efforts to try and slow down the buy-stealth, unstoppable global central bank price revaluation that we can see underway. And as we drew attention to last time, when we were recording this episode on the 27th here, much as the strategically timed launch of the Shanghai Futures Exchange, how that blindsided traders betting against gold, the stealthy Chinese BRICS-related initiative to allow over 55 million SMEs to access and trade fully paid for physical gold and silver on the SGE physical exchange is going to ultimately attract hundreds of tons of Western-sourced gold and silver into China to meet this demand. We also drew attention in our last episode, these fresh PBOC bullish gold and silver drivers once more became evident. This is why we identified this blue circled higher stair step being anchored in both gold and silver on the 14th of November. Both of these gold revaluation events provided headwinds against the wrong at both ends momentum sellers who, obviously in the middle they're right, but they're wrong at both ends. And of course the insiders, the cartel, knows exactly those points. Then obviously they're blind to the bullion banks buying gold into them, which is exactly what's happening, because they still continue to try and cap rises in gold and silver. And we see it consistently. And again, we're going to run into, I'm recording this between the AM and the PM fix, and it's before news. I think we've got CPI today. So obviously that is going to be volatile, but I mean, they'll use every effort to try and sell rallies. They're not long yet, which is actually great news because very short term, we've evidenced gold open interest migrating into Bitcoin futures. And while we wish good riddance to these volatility driving momentums, switching then 75% of the gold and silver open interest they control.
AndrewMaguire, in an interview at Kinesis Money, points out that silver is poised for a significant revaluation due to multiple factors converging globally. Unlike gold, silver has not yet been reclassified as a first-tier asset, but China is aggressively driving demand through its Shanghai Gold Exchange, SGE. This initiative incentivizes millions of smaller investors to purchase and trade fully paid physical silver, draining global above-ground supplies already strained by a multi-year deficit. The market is shifting away from paper-based silver pricing on platforms like COMEX, moving toward physical pricing where each bar has a genuine buyer and seller. AndrewMaguire indicates that liquidity providers predict that silver could soon reach a three-figure price due to growing demand, short squeezes, and margin calls. Bullion banks are already long on silver and gold, anticipating an imminent breakout, potentially as soon as early January. This shift undermines derivative structures and suppressive practices, setting the stage for explosive growth in silver prices. Now let's shift our attention towards the interview.
It's unlike gold. This has been the problem with silver. Unlike gold, it's not yet been formally reclassified as a first-tier asset class. So, but nevertheless, it's a component of Beijing's war efforts alongside hedging, foreshadowed tariffs to come. Liquidity providers assess the relaxing of the SGE rules that we looked at last time is specifically focused on attracting large silver bullion flows into China to meet military and industrial demand. Now, as we outlined in our last episode, by incentivizing millions of smaller investors, that's the millions of SMEs that we looked at on the charts as well, incentivizing them to buy and to trade fully paid for silver, it is greatly impacting global supply, draining underpriced silver already facing a 4-year massive supply deficit. Now, while there is a commodity element to silver, silver is classified as money, which is why, unlike any other commodity, it trades as a foreign exchange cross. So, as I say, long silver, short dollar, yen, etc., or the other way around. Now, with pricing being established in the physical exchanges, where there is always a tradable buy and sell order for every single bar that is actually traded, it's also going to put silver onto the revaluation stair steps. And it's just as when the Bank of International Settlements reclassified gold as a first-tier asset class on the 1st of January 2023. And what that did was force the multi-trillion-dollar FX gold to become NSFR compliant, which meant that liquidity providers all of a sudden had to back each buy and sell order with physical gold. So that was a big change that changed what was really an unallocated market into a physical market. Now, by actually pricing physical silver or physically pricing silver in the FX markets, the silver fix event will produce the same result, which each silver bar will have a real buy and a real sell silver price, and a real silver price will emerge from that fact. It doesn't matter what the price of silver is, there's always going to be a buyer and a seller, but it's not going to be settled in the paper markets. And when we look back at silver in the rear view mirror, when it's trading with a 3-figure handle, yeah, you like that, Shane, it will be realized all the signs to act are really right under our noses now. And at the margin, this fresh SGE demand will be the next catalyst to drive a series of higher physically driven stair steps, this time also revaluing silver. It will begin to bullishly undermine the current bearishly skewed multi-billion-dollar options and OCC structures. We talked about these structures before. These are derivative structures. They're backed by nothing. Now, we've not really evidenced a real balanced supply-demand silver price, really, since it was fractionalized and diluted to be traded on the COMEX about 50 years ago. Now, with silver, with silver supply actually being sucked out of above ground stocks right now into this growing supply deficit, it actually raises the question, which we raised last time. What is that price? And while no one exactly knows, every well-connected liquidity provider assesses it has to be a 3-figure price. And once the short squeeze and margin calls hit, it will happen faster than most people realize. This is why every single bullion bank, without exception, is long both gold and silver for their own books. So really, kind of to sum that up, at the margin, this completely unfactored, fresh, bricks-driven SGE silver demand is going to make it impossible for the fast dwindling above ground supply. That there's not enough supply for the so-called LBMA silver professional trade that they call themselves to suppress a globally driven spot silver price breakout into all-time highs. Now, liquidity providers give it till the first week in January for the lid to blow off. I mean, we are talking imminent here. And yes, the clues are all there under the deliberately induced chart noise. In other words, what's going on in the paper to physical battle, which is actually designed, it's the whole reason the COMEX was designed, to keep investors on the sidelines into what looks like a non-performing asset class. Why? Because so much paper, silver, and gold as well has been introduced to actually make it look like that it's non-performing. Whereas silver has quietly been leading gold higher and is looking explosive all our liquidity providers agree something large is going on in silver.
The global silver market is pivotal, with increasing physical demand and a tightening supply driving expectations of significant price revaluation. Combined with central banks' growing interest in precious metals and a shift away from paper-based pricing mechanisms, these dynamics suggest an imminent breakout for silver and gold prices. Investors and market participants should closely monitor these developments as they could redefine the landscape for precious metals trading. How will reclassifying silver as a first-tier asset impact its price and market dynamics? What role do initiatives like the Shanghai Gold Exchange play in reshaping global silver and gold markets? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.